Welcome to our deep dive into interesting topics.
Glad to be here.
Today we're digging into smart contracts and tokenization.
Yeah, big topics. Basically, automating agreements with code on a blockchain and turning real-world assets into digital tokens.
Exactly. And this isn't brand new, right? The core idea of smart contracts, that actually goes back to the 90s. Computer scientist Nick Szabo.
That's right. Szabo coined the term. But, the tech wasn't really there yet.
Right. So for you listening, this stuff is moving from, let's say, the theoretical to the practical. It's starting to reshape industries.
Absolutely. And our goal here, drawing on the insights from Jörg-Owe work, is to give you a solid shortcut to understanding what this all means, why it matters.
We're going to cover it, quite a bit. The history, the tech side, the nuts and bolts, where it's being used, the upsides, the downsides, where it might be going.
And the legal stuff, too, the regulations. It's all connected.
Definitely. So let's jump in. Where should we start? History.
History makes sense. So Szabo, 1990s. But like I said, it was mostly conceptual. Bitcoin's launch in 2009, that was the game changer.
Because of the blockchain, the underlying tech.
Exactly. Bitcoin provided that foundational distributed ledger, the blockchain, that made smart contracts actually feasible, something you could build on.
And then you have governments starting to notice. Italy, the essay mentions, was actually the first country to legally recognize smart contract and distributed registry technology.
Yeah, that was a big deal. A really key step towards, legitimacy and broader adoption, giving it that legal footing.
And we're already seeing real-world uses based on this. Healthcare, for instance. Chronicled.
Right. Chronicled is a great example mentioned in the essay. They're using blockchain, using smart contracts to basically secure the supply chain for pharmaceuticals and medical devices.
How does that work in practice? A smart contract managing pills?
Well, kinda. The smart contract can automatically verify if a product is authentic as it moves along the chain. It can even trigger payments automatically when certain conditions are met, like delivery confirmation.
Okay, so that fights counterfeits.
Yeah.
And speeds things up.
Precisely. Huge implications for patient safety, stopping fake drugs, and just making the whole process more efficient. Less paperwork, fewer delays.
That makes a lot of sense. And then tokenization kind of builds on that, doesn't it? Using these contracts to represent ownership.
It's the logical next step. You take an asset, like, say, a piece of real estate or even intellectual property, and you represent ownership of it with a digital token managed by a smart contract.
So you could own, like, a tiny fraction of an office building.
Exactly. Fractional ownership.
Yeah.
That lowers the barrier to entry for big investments. And it makes these assets, which are normally hard to sell quickly, much more liquid. You can trade the tokens potentially much faster.
Okay, got the history, the evolution. Let's get a bit more technical now.
Yeah.
A smart contract, what is it fundamentally?
Think of it as self-executing agreement. The terms, the rules, if this happens, then do that, are written directly into code on the blockchain.
And once it's on the blockchain?
It's basically set in stone, immutable. It runs automatically when the coded conditions are met. No need for a traditional intermediary, like a bank or a lawyer, to enforce it. That's the core idea. Reliability and automation.
But as the essay points out, it's not without challenges, right? Technical ones.
Oh, definitely. There are technical hurdles, for sure, and legal operational ones, too. From a technical standpoint, you need programming languages. The big one, especially for Ethereum, is Solidity.
Solidity, is that hard to learn?
Well, it's influenced by C++ and JavaScript, so if you have background there, it helps. It supports things like inheritance, libraries, making code reusable, but then you've got Rust gaining ground, too.
Rust. For other blockchains?
Yeah. Platforms like Near, Solana, Rust is different, more low-level, multi-paradigm, gives developers a different kind of control.
And both of these are. Turing complete, the essay says. What's that mean for us?
Turing complete, yeah. Basically, it means the language is powerful enough to compute, anything computable, given enough resources. So you can write really complex logic into these smart contracts.
Which sounds powerful, but maybe a bit risky if you make a mistake.
Exactly. That's the double-edged sword. Because they're immutable, can't be easily changed. Once deployed, a bug or a flaw in the code can lead to potentially huge, irreversible financial losses.
The testing is critical.
Absolutely critical. Rigorous testing, formal verification, independent security audits. You have to be incredibly careful before deploying these things.
Makes sense. Okay, and shifting to tokenization, what kinds of tokens are we talking about?
The essay breaks it down nicely. You've got equity tokens, which are like digital shares in a company. It might come with voting rights, profit sharing, that kind of thing.
Like traditional stock, but on a blockchain.
Kinda, yeah. Then there are security tokens. These represent ownership of regulated financial assets, bonds, maybe traditional securities, even real estate sometimes. They often pay dividends or profits and fall under securities laws.
Okay. And the last type?
Utility tokens. These are different. They don't usually represent ownership. Instead, they grant access to a specific product or service within a decentralized application, a DApp. Think of it like a key or maybe an in-app currency or voucher.
Got it. Equity, security, utility.
Yeah.
So knowing the tech, where is this stuff actually making waves? What are the use cases?
Oh, loads of places. Real estate, as we mentioned, is a big one. Fractional ownership, making it easier to invest, potentially more liquidity, faster deals without so many middlemen.
Cuts out some fees and paperwork, I imagine.
Hopefully, yeah. Then there's intellectual property patents, copyrights, trademarks. Tokenization could streamline how creators manage and monetize their rights. Licensing could become simpler, royalty payments more transparent and automatic.
And finance. Seems like a natural fit.
Huge potential there. Tokenizing stocks, bonds, you name it. Again, fractional ownership, potentially faster trading and settlement, maybe lower costs, broader access for smaller investors. Smart contracts could automate tons of the back office stuff.
Asset management, too.
Yeah, for asset managers, it could mean more liquid investment options for their clients, shorter lockup periods maybe, easier portfolio management if there are secondary markets for these tokens, plus better transparency for tracking assets and reporting.
We mentioned healthcare earlier with Chronicled. Any other ways?
Well, beyond supply chains, think about patient data. Securely sharing records, clinical trial data, but with the patient having more control over who sees what, that could really boost privacy and maybe even speed up research.
Interesting. What else? Agriculture. Art.
Yep. Agriculture and commodities, tokenizing assets to make trading easier, improve market access, track where things came from, provenance. Art and collectibles is huge, especially with NFTs, non-fungible tokens. Fractional ownership of a masterpiece, proving authenticity, tracking ownership history.
And gaming. I hear a lot about that.
Oh, yeah. Gaming and virtual worlds. Players can actually own their in-game items, virtual land, unique weapons, whatever, as NFTs. Guarantees uniqueness, lets them trade or sell them, creates whole new economies, new revenue streams for developers, too.
Wow, okay. The applications are really broad. So, summarizing the benefits then, what are the big takeaways?
I'd say number one is that increased liquidity and fractional ownership. It just opens doors for investing in things that were previously out of reach for many, makes markets potentially more efficient.
And the transparency aspect seems key.
Definitely. Enhanced transparency and security. Everything's on that immutable blockchain ledger, visible to authorized parties. That builds trust, makes things more accountable, and the automation reduces human error, potentially fraud.
Leads to better efficiency overall.
That's the third big one. Improved operational efficiency. Fewer intermediaries. Automated processes can mean lower costs, faster execution, less manual work.
And you mentioned integrating with other tech, AI, IoT.
Yeah, innovative asset management solutions.
Yeah.
Imagine combining smart contracts with AI for better investment strategies or IoT sensors for real-time monitoring of assets tied to a token. Smarter decisions.
The essay even touched on fair labor and sustainability.
It did. It's interesting. Smart contracts could automate worker payments based on verifiable conditions, ensuring compliance with labor standards, maybe even track ethical sourcing, and potentially optimize resource use for environmental benefits, though that's maybe further out.
So overall, it's about wider access.
Broader market access, yeah. Democratizing investment, making the whole financial ecosystem potentially more inclusive.
Okay, sounds great on paper. But let's be real. What are the challenges, the limitations? This can't all be smooth sailing.
No, definitely not. Big hurdles exist. Legal and regulatory uncertainty is probably top of the list. The rules are still being written, basically.
Right, like the Italy example versus the U.S. state-by-state approach.
Exactly. Italy took a step. Arizona explicitly approved smart contracts legally. Nevada and Vermont recognized blockchain data. But that patchwork creates complexity and risk, especially for cross-border stuff. Is a smart contract legally binding everywhere? How do you resolve disputes?
And security. You mentioned the DAO hack earlier.
Yeah, security is a massive concern. Code vulnerabilities can lead to catastrophic losses, like with the DAO hack that was, $60 million worth of Ether back then. Plus, the usual cybersecurity threats, hacking wallets, phishing scams, targeting digital assets.
What about technical limits beyond just bugs?
Well, that immutability we talked about, it's a benefit but also a limitation. If circumstances change or you need to update the contract, it's really hard, sometimes impossible. Flexibility is an issue, and sometimes the terms, even in code, can be ambiguous or not cover every eventuality, leading to disputes.
And the value of these things can swing wildly, right?
Yeah.
Market volatility.
Huge risk. The price of the underlying crypto assets can be incredibly volatile. If you tokenize a traditional asset like real estate, but its value is somehow tied to a fluctuating cryptocurrency, that introduces instability, risk of overvaluation, speculative bubbles.
Are there infrastructure issues too, like getting different systems to talk to each other?
Interoperability, yeah, it's a challenge. Getting different blockchains and protocols to work together smoothly. And scalability, can these networks handle millions of transactions quickly and cheaply? Some blockchains, like Ethereum, have faced congestion, though upgrades like Ethereum 2.0 aim to fix that.
Anything else? More? Human factors.
Yeah, cultural and behavioral barriers. Just plain resistance to change. People are used to traditional systems. Understanding blockchain, trusting smart contracts, it takes time and education. Adoption can be slow because of that inertia.
So with all those challenges, where are things heading? What are the future trends we should watch?
Well, I think we'll see more technological integration, more AI, more IoT woven into these systems, making them smarter, more data-driven. Also, expect development towards more adaptable or upgradable smart contracts, trying to solve that rigidity problem.
And the rules will eventually catch up.
That's the hope, and a definite trend. A growing push for standardization and clearer regulatory frameworks. That's essential to build trust, reduce uncertainty, and really integrate this with traditional finance. People need to know the rules of the game.
So more clarity, more integration.
And continued democratization. Easier access for investors, better user experience, stronger security. These will drive adoption. The focus will shift towards making this usable and safe for more people.
What about those ethical points you raised?
Yeah, ethical and social considerations will likely become more prominent. Using this tech to ensure fair labor practices, promote sustainability, especially in supply chains like fashion or food, it won't just be about efficiency and profit.
Okay, let's quickly zone in on that regulatory landscape again. It sounds like the main bottleneck right now.
It's certainly a major one. The complexity really impacts adoption, especially in finance, where compliance is everything. Existing frameworks weren't built for this, so regulators are playing catch-up. That uncertainty definitely slows down asset tokenization.
And for the smart contracts themselves, legally speaking.
Key questions remain. Enforceability, jurisdiction, especially across borders, compliance with various laws, how disputes get resolved. Industries like fashion, dealing with global supply chains, face a real maze of regulations.
Standardization seems critical too.
Absolutely. Lack of standards hinders interoperability, increases risks, and there's a skills gap, finding people who really understand both the tech and the legal side. Plus, overcoming that stakeholder resistance we mentioned, it all ties together.
But those state initiatives in the U.S., like Arizona, they offer some hope.
They do. Arizona explicitly defining and approving smart contracts in law, HB 2417 back in 2017, I think, is significant. Nevada and Vermont recognizing blockchain data as evidence. These could act as precedents, encouraging more legal clarity elsewhere.
Okay, so let's try and wrap this up. Key takeaways.
Smart contracts and tokenization clearly have massive potential. Efficiency, transparency, accessibility across so many industries.
But the challenges are real. Regulation needs to mature, security needs constant vigilance, the tech itself needs to keep evolving, become more scalable, more interoperable. Widespread adoption isn't guaranteed overnight.
Precisely. Hopefully this deep dive has, given you a clear picture of both the promise and the hurdles involved with these complex technologies.
Absolutely. And maybe a final thought for you to chew on based on our discussion. How might that growing legal recognition, like we saw with Arizona's law, actually start to reshape traditional contract law? What could that mean for business, for finance, maybe even for your own everyday agreements down the line?
Definitely something to think about. The intersection of code and law is only going to get more interesting.
Indeed. Well, thank you for exploring these ideas with us today, drawing from the work of Jörg-Owe.